Hello, fellow Robo Capitals. Hope you're well. So I am back with my good buddy, Patrick Ceresna. And boy, oh boy, is the timing perfect. We just had GDP come out today, negative 0.3%. Now, there's a lot to unpack there. But what I want to do with Patrick today is go through what the charts are telling us, some technical analysis about what will likely happen over the next few weeks, next few months with gold, commodities. I mean, oil, as an example, is down to the 50s, for heaven's sakes. Gold almost at all-time highs, equities, interest rates, treasuries, etc. So, Patrick Ceresna, let's dive right into the charts, buddy. You want me to switch up screen view?
Well, I mean, listen, you nailed it today when you talked about the negative GDP. I know you were live streaming on this topic earlier as well. And, you know, the big question everyone was asking was, you know, do we, because of the, shrinking of the fiscal spending through all the anxiety about tariffs, businesses cutting back, does this contract the economy? That was like the big puzzle to solve, right? And what's clear is that with 1 quarter negative GDP, we're now on the way to the official definition of a recession, which is 2 negative quarters.
Yeah. Patrick, do you think, what camp are you on? Because, if you...
It's a recession.
Polls are saying, they're like, no, this is fake news. This is nothing. Because it's all about imports. We imported so much stuff, and that detracts from GDP. So if you just extract the imports due to front-running tariffs, then we would have a blowout GDP. So are you on that camp or more than bearish?
No.
Well, the other components, along with oil and everything else that's happening, it's probably the negative report is actually probably negative.
Well, I mean, I would go with much bigger picture, and I wouldn't get caught in the weeds of debating the number as much as understanding something that me and you talked about for years when we've been on the show. When there's a bigger monetary cycle that goes on, and when the central banks raise interest rates, and they basically are putting on the brakes of the economy. But there's a lag time from which the recession inevitably kicks in. As an example, Bernanke, actually, let's actually take a moment. Let's talk about this. This is actually really, I'm going to put on a weekly chart. I want to go back to
Fed funds if you want to go through.
I have that too. But I want to just talk about the actual financial crisis in a moment. Let's start with this. So point here is that the Fed.
That's a little small, Patrick. What is that a chart of? Just to be clear.
This is the S&P 500.
Okay, got it.
Right. So that we're just talking the S&P 500, and what I want to highlight is simply the fact that the Fed was basically raising interest rates from 2004 all the way to 2006. So this red square, you have to squint your eyes. You should have made it a different color, but that's red box was where they were raising interest rates. Then when they kept Fed funds unchanged for a year, right, they basically from mid 2006 to mid 2007, the market kept going higher while they kept rates unchanged. Right. Then when we even had the first subprime breaks in the market, the Bernanke cut interest rates, and they started cutting interest rates, and the market still in October 2007 made a higher high, right? Yeah. And when was the recession? When was the official recession? September. No, that was the start of the bear market. But when was the recession? The recession actually was in September of 2008 was the official start of it.
But the point is not September 2008.
Yeah. Hold on. Let's have a peek at this. I hope
you're talking about the MBER, right, Patrick?
Yeah, exactly.
No, that was either December of 2007 or January of 2008.
The point being that there was a lag, a considerable lag, to when the recession started after they already started cutting interest rates.
Correct. Yeah.
And the point being is that everyone gets all caught up in this idea that the market should have had or the economy should have had the recession back into here in 2024, 2023, when we, let's say, had our regional bank crisis and all those things. We talked about it. We were all in the concern of the inverted yield curve and all of these different red flags that were coming in. But ultimately, there's a lag time for when they tighten interest rate conditions, when it ultimately seizes things up. But what Trump did is he added a second input variable, and that's business uncertainty. When businesses don't know, where they're going to be able to import their stuff from and how much it's going to cost them, or where their business is going to be because of this transition, all they do is say, let's just pause and see what happens. It causes companies to just temporarily hit the brakes so that they see where the dust settles, so that they can make a proper business decision once they see the result of the tariffs and how they have to restructure and reorganize.
Right.
And so now we already had conditions that were ready for a recession, and the tariffs, I believe, just put it over the top.
Yeah.
And now, does it have to be a nasty one? Well, I mean, you had Ray Dalio out there, pimping his new book that was basically talking about the fact that this could have been, or this can be worse than a financial crisis. I don't know whether he's just doing that to sell books, but he has an agenda. But he's already in that pretty bearish camp in terms of the knock-on effects. But you have some pretty smart people out there that are already calling that this is a bear market. Now, we're in a situation where we got a stock market that got pummeled largely because of the kind of scare about the tariffs. And it became a reality check. It was sort of, George, I mean, you listen to Macro Voices, and so that back in 2020, Chris Martinson and all these other guys were coming onto our show talking about how bad COVID could be and how this, and the market didn't give a shit. And the market didn't give a shit, and it didn't give a shit. And then suddenly everyone gave a shit all at once.
Yeah.
And that's what I describe what happened with the tariffs, which was everyone knew the tariffs were coming. Everyone said it's not going to be so bad. And then suddenly everyone realized all at once.
Euphoria when Trump gets elected and gets into office, and it's going to be great for business. He's going to cut taxes, and it's going to be Trump 2.0 and all. And then people are kind of sidelining and forgetting the tariffs or the declining economy, which I would point to like airline demand. It's not like airline demand just fell off a cliff. If you listen to the CEOs, that it started to decline in January of this year. Just backing up your point about the tariffs being bad, but it's kind of the straw that broke the camel's back of an underlying economy that was already weak.
Absolutely. And so we have a scenario where there was going to be a slowdown, and Besant and Trump and anyone else are actually out there saying this isn't bad. You want to allow the markets to have corrections because, for instance, Besant came out and said that if they allowed the bubble to let some air out back in 2006 and 2007, then 2008 would have never happened. There's an argument that basically that things got too frothy, and this is not, and markets correcting is not a bad thing. He's literally said that when he was on Meet the Press. And so the point being is that I don't think that they have an issue with the stock market correcting a bit and in the pushing of their agenda. The question is, does this create a negative feedback loop? Because, okay, if we have a couple of quarters of negative GDP, who gives a shit? The market can just turn around and rip higher from there. It doesn't have to be doomsday. Just because recession has this trigger word to everyone, 2 negative quarters of GDP is not the end of the world. But what is going to be the big question is, does this spur the negative feedback loop of a contraction in corporate earnings? Because if you look at every past recession, what caused bear markets, the ones where the stock markets wiped out 30, 40, 50% of their values, were because of the contraction of corporate earnings, where earnings came 10, 20% off of their highs. And suddenly no one's willing to pay a 22 multiple for contracting earnings. And suddenly they're pricing in a 20 or an 18 or 16 multiple on your PEs for that. And suddenly you're talking 40, 50% declines in stock markets. So the puzzle to solve is not whether there's going to be a recession, because I think the recession is almost a given. What is the bigger question? Is it going to be a bad one that causes corporate earnings to contract? Because that is what's going to decide whether the stock market's going to take a shellacking here in the next.
Indicators do you look at other than technical? We're going to get in the technicals in a moment.
Yeah.
What other indicators do you look at to see what's going on with those corporate earnings that you're talking about are so important, whether or not we have a...
It's not indicators. It's actually the earnings. Like, for instance, the next 24 hours is going to be huge. We're right now, as we're recording, we're about to get the earnings for Meta and Microsoft.
Okay.
You're about to get Apple and Amazon tomorrow. We're going to get 4 behemoths giving forward guidance in terms of what they believe is going to be the path of their earnings.
So you think the forward guidance is more important than the earnings themselves for this round?
Oh, absolutely. What they report is nowhere near as important as their guidance for the rest of the year.
Okay.
They're going to say, guys, you got to bring down expectations. Things are tight. We're not going to be hitting these numbers, and they guide everyone down a different path. The guidance is 100% more important. And what analysts start to gauge as to what the real path of this is, right? And so right now, by the way, so on that GDP number, I love watching Polymarkets. You know why I love watching Polymarkets? Do you track Polymarkets at all?
I mean, I know what it is, but I don't.
Okay, so Polymarkets is just the betting markets for everything on elections or recessions or nuclear war or whatever. They let you bet on freaking everything. What I love about this site is that it's betting with real money. When you have some hotshot Goldman Sachs and economists come out in a Brioni suit, fucking talking shit, and it's like, we think the recession risks are this and this. They're just talking shit. They're talking their books. They're talking the agenda that the bank has. How do you trust that? What I love is in the betting markets, this is where literally millions of dollars is being bet on what the outcome will be. And therefore, you're allowing money to talk. This is where, and here, right now, they're putting a 67% chance of a recession this year on Polymarkets. This is the highest we've been, even back during the last decline back in April. We were only like at 63, 64%. So this GDP number that came out shot this thing temporarily even to 70% on the upside. And
is that a big move that I can't see how long that chart is, Patrick. Is that move up there? Is that today or is that?
This move right here where I'm talking was back in April 7th during the worst part of the market dump.
What about
right? And on the far right is today. And this is where we're at 67.
Basically, we're worse than we were like April 4th.
Exactly.
Okay,
and so we're right now at the highest probability of a recession, and you can tell that even in the SOFR futures market. We can talk about the technicals there, but they're starting. Like, one of my big theses has been that the Fed is I don't know whether I want to say that, dare say the word deliberately, but they are certainly executing policy error. The idea that they're focusing far too much on inflation fears, and they are going to be late to the rate cutting party.
Yeah.
And they are in itself, by not having lowered interest rates sooner, they're actually going to make the recession happen. And then when they have to make their dovish pivot, suddenly the market's going to have to price in an extra 4 rate cuts that it's currently not pricing.
All right.
I honestly will not rule out that we go down to 2% on Fed funds. Like, I think that there's a legit chance that we are heading, like, so Here, let me put on the SOFR futures. So let's, for our listeners, let's take a moment to actually explain to them how SOFR futures work again. And so a SOFR future is basically just pricing in 3-month money market rates in overnight lending or 3-month lending rates at some point in the future. I'm particularly here focusing on December of 2026. So when we're looking at this, we're talking 18 months forward, essentially, right? I'm a little bit more than, but I'm just rounding it to 18 months, a year and a half. They're
So it's
basically
where the futures market is betting SOFR
exactly.
will be in 18 months.
Exactly.
Okay.
And so whatever the number, so right now it's at 97 to the dot. I mean, it's a little bit, but let's round it for our listeners to just say it's 97.
Just to be clear, that means it's predicting 3% on Fed funds.
Exactly.
It's the delta between 97% and 100, right?
Right. So basically, what it is that it's 100 is zero interest rates, and therefore whatever it's trading at 97. So 100 minus 97 is a 3% rate.
Okay, got it.
So right now it's pricing 3%. Now we went when last time actually I was on your show with you, we were down at 96. So the market has already, since the last time I was with you, priced in 4 additional rate cuts that were not priced in when we talked earlier this year.
Okay.
And I will not be shocked if this thing rips to 98. And that would be the highest that we've seen these SOFR futures trade since back in 2022. Like in order to get to 98, you're talking about levels in the 2022 decline when we were up at that 98, 99 levels during the bond crisis, where the Fed was easing during that cycle. Anyway, I continue to think that policy errors happening and that being long these SOFR futures is an absolute no-brainer.
For to time that, Patrick,
Yes,
because what I'm
absolutely.
noticing here is you're getting higher lows and you might be getting higher highs. So would you be waiting? I know people can't see what I'm pointing at, but would you be waiting for SOFR to exceed the prior high?
Uh, I mean, if you want to be like particularly, I've been already long since when it crossed the 50-day moving average, right? So, we started coming in here, but what's over here? But each time this thing is dipped, it's dipped towards the moving averages, immediately found support, lower highs in each sequence of dips, and so we've had a very systematic rise in this that is a clear bull trend. Now it is approaching overhead resistance, but I don't like to look, at least in the SOFR futures, on the pure technicals of support resistance, because really what this is the market pricing in the economy. It's about what we're talking about is where will the Fed have to go, and what do the markets need to price in for the Fed path,
Right.
right? And
Psychological components that go into resistance and support aren't as impactful, let's say, in the SOFR market.
well, yes, I would say that. Because I think you're really truly trading macro here. You're making a call in terms of where the economy is going and ultimately how much the Fed will have to move in order to get to R star or whatever, wherever the ideal interest rate is for that environment. Nonetheless, we have, I believe, a scenario where once the market has one more little scare, we're going to have the Fed having to ultimately make the dove pivot. They're going to have to drop this kind of, we have to wait and see because inflation seems sticky shit that they keep talking about. And they're going to say, no, we have to provide some stimulus for the money markets, for repo markets, for the economy. And they're going to, at some point, have to provide that. And it's going to involve the cutting of interest rates. I think that this is going to continue to be a trade. So you have all these things indicating recession. You have the market pricing in more rate cuts, which is clearly an indication that they see the path of the market towards a recession, right? The only reason the market prices cuts is because there's something's going to break, right? The second thing, things like the oil markets, and you were talking about I don't know do you have a specific order you want to go at, or you like this freestyle? Should we just go with it?
Yeah.
All right. So like the breakdown in crude oil is also just a further confirmation of this, right? Like we have a crude oil market that is in a direct free fall. Well, and it's not just crude oil, but it's also for gasoline, which was the big headline recently. And gasoline is right back down toward its lows. This is the RBOB gasoline futures. And so you have a scenario where the economy, we're going into summer driving season, right? And you're $2 a gallon. This is not seasonally normal, right? Like you normally are going to have the summer driving season, construction season, all these different things that typically drive gasoline futures simply not impacting the markets. And so so this continues to only add the further puzzle pieces pointing to the same conclusion. The other thing, we've talked about it before, but junk bond credit spreads. We were basically trading on the junk bond credit spreads at decade lows at the start of the year.
Yeah.
Like and so for our listeners that don't know what that means, is it means that for owning a piece of shit bond that has a very low credit rating, that has a chance of default, how much interest will you gain as an investor in investing in that bond over that of a secured treasury bond, which is guaranteed by the government? And while, yes, China is selling those treasuries, the government can always print money to repay you. So the odds of a default on bonds is almost zero.
The fact that the 10 years 20 basis points under Fed funds. I don't care how much China's selling. Somebody's out there buying a lot, Patrick.
Absolutely. But so you have a scenario, though, that junk bonds did take it on the chin. And so here, let me just put up just a junk bond ETF like JNK. But we had a pretty serious puke on the downside in April. I mean, we got a bounce. But to me, this was the canary in the coal mine. I said, because the way I always look at it is you can always have a 5 to 10% market correction, and the junk bond markets don't care. Right. But almost every 20 to 30 to 40% market move, the junk bonds are puking on the downside. So I kind of looked at it as like, when will the junk bond markets, I look at them like a canary in the coal mine, like when does it die? And when is the credit spread start blowing out? Because they now have to price in that the default rate on many of these junk bonds are actually increases, and therefore their premium that you have to earn on top of Treasury has to be priced in, and therefore they often are correcting far more violently than standard in even investment grade bonds, right? And so these junk bonds were just giving all sorts of red flags on the downside. Point is, I think the odds of a recession are almost a certainty, as close to a certainty as you're going to get. But what we don't know is the severity and or whether corporate earnings are going to be massively impacted by it. And that is going to decide whether or not this is going to be a nasty one. Like, is this going to be a bear market or not? I tend to be always far more cautious personally, and always skeptical and thinking that there's room for things to get ugly. So right now, this is
which chart is this?
This is the S&P.
Okay, so forget the macro stuff that you know.
Yeah.
Exclusively looking at this chart. If you just came down from Mars or something like that, and I just showed you this chart, knowing what you know about technical analysis.
Bearish as fuck.
What? Okay. Yeah.
Bearish.
And specifically, I mean, it's obvious.
Okay.
Chart.
So
let me do like a pushback here.
Yeah.
And I don't really know technical analysis, but I've seen people draw a lot of lines before. Right. And so again, I don't think they can see what I'm pointing to right there.
So
there you go. See how you broke the red line. So is that possible that that could be a bullish sign that we broke that and now we're, higher? I don't know what you call that trend line, but the fact that we broke it, it's a good sign, right?
Oh, it's just a trend line. I am always skeptical of that per se. What I'd like to break it down. I like to break technical imbalance down even more to a basic level. And the way I would approach this is I would basically say the markets typically move in this kind of 2 steps forward, 1 step back, 2 step forward, 1 step back. This is like a natural ebb and flow wave movement.
Right.
And so when a market has such a vicious drop like we got on the downside over here, think of it like a bungee cord tied to someone jumping off of a bridge. Once the bungee cord gets stretched far enough, the market reflexively snaps back the other way and bounces. These are called bear market rallies. And bear market rallies tend to be violent to the upside. Remember that day back just earlier in April where we were up 10+% in one day?
Yeah.
That only ever happens in bear markets.
Right.
I'm serious. It only happens because it needed to have a violent drop happen prior in order for that kind of a rally to occur. And so the best is to give you an analog of, let's just go through a couple bear markets.
Okay.
So this is the 2022 bear market. I consider this not to have been an equity bear market. It was a bond bear market. That was where the 30-year lost 40% of its value. It was a vicious bond repricing during that period, and equities had to reprice. But this was almost a year-long bear market, right? And I want to highlight is that I could have also drawn on this trend line right over here and using the exact same argument on this rally over here, I would have said, well, it broke the trend line. It must be bullish.
Yeah.
But it didn't really, right?
What spreads doing during that? Were they
Sorry?
blown out or were they still pretty tight?
Oh, they were blowing out. I don't have the exact thing. We can point here. I'm just trying to highlight is bear market rallies like this and like this happen. This is an inherent feature of bear markets. Let's say look at the early part of 2008. Like so going back here. Actually, I'm going to put this on a weekly chart. It's just going to be easier to analyze here. I want to highlight is notice, for instance, on the first violent 20% drop in 2008, like that January of 2008. Look at what the stock market did in the following period. It did a bounce, right? And that bounce, for instance, off of its lows was a 10% 70-day rally. So for 2 months, the market rallied and went up 10% before the next ugly decline.
What was that, Patrick?
That was in March and April of 2008.
Where we were in a recession. Right?
Yeah, we were already in a recession. The stock market started with a decline of 20%.
Yeah.
Right?
But
bounced 10%.
But to be clear, the NBER hadn't announced that we were in a recession.
Right.
So some people were saying yes, some people no, almost exactly what we're doing now. And then finally in December of 2008, the NBER came out and said, oh yeah, by the way, just FYI, we've been in a recession for the last 12 months.
Well, exactly. It's always late, but back to the analogy I wanted to give you, the two, like a dance, 2 steps forward, 1 step back, right? Well, if you go down 20% and that's 2 steps down, what's 1 step back? 10%. And what was the length of the rally? Roughly 10%, right? Like this is the natural kind of ebb and flow. Take, for instance, this is the tech wreck bubble. And you also had the same scenario. Look over here where the first wave of 2000 into 2001, you had this vicious decline, and then you had this market bounce. This market bounce right here looks tiny, doesn't it? But on a percentage basis, that rally was 14% of a market rally off the low. that lasted 49 days. We're only 3 weeks into our market bounce, up 15%. Point here is even then the market turned around over here, declined again with a vicious, the second leg decline. What at the time was a 25% decline. And what was the length of the bear market rally? 21% bounce. 21%. Point is that these kind of market bounces happen. And so just because we're getting this market bounce doesn't make it a bull market. It doesn't make it the end of this sell cycle. What's the only thing that literally will save this market is if we don't have a corporate earnings recession. Like I'm saying, I still believe that these are always driven by fundamentals. Like all the squiggles we're doing, what is it that I seek out of the squiggles? Like out of chart reading and technical analysis, it's to identify moments of asymmetry where I can put a small risk in and have the potential to make really big money. Like you're using the charts to try to identify moments where that risk reward is set up nicely. But ultimately, the drivers of the big moves are driven by fundamentals, right? This is where as a technician, you never want to say, "Oh, this is all about squiggles and not about fundamentals." No, the fundamentals are there. What we're doing is we're studying the way investors are reacting and behaving to those fundamentals. As the information is released, what is the story of the way they're voting with their money telling us, right? We're studying that. And so this has all of the characteristics of a bear market rally. And we are coming into a jobs number. We just had the ADP and JOLTS come out with disappointing numbers. If Friday's jobs numbers comes out with where the SOM rule fucking blows out, you've got a scenario where suddenly, the market's going to have another freak out.
Oh, I didn't know on payroll was this week. Oh yeah.
Yeah, like it's coming up, right? And so like literally me and you are online together right now, just right before a very important next 48 hours. Well, not actually not even 48 hours. Forget I guess like 36 hours. We're going to get actually right now if we could probably have a look at what the reactions were to Microsoft is gapped up this right now. Microsoft's up like $20 in after hours government's earnings, and Meta is up about $30 as well. Okay. So right now, at least the first reactions to the earnings of these two was higher. And so so S&P's up 38 points here in the
future
in the futures markets in the after hours. But it's going now that we have that Apple and Amazon coming out tomorrow. And then we're going to have this jobs number coming out on Friday. It's going to be important to see how the dust settles on all of this.
Okay, so I don't really know how these announcements work, so I don't follow them too much. Do they announce their numbers first and then give guidance, or
because no, the guidance is given during the conference calls.
Okay,
so the first thing that's released is just the top line and bottom line numbers, right? Like what's their revenues and income. And
conference calls have been done yet?
No. Well, I mean, they're probably on them right now. And this is why, like, by tomorrow morning, these stocks could be negative, and more importantly, like as an example, both of these gaps higher on these stocks, if they occur, take a lesson from Google. Google had a positive earnings. It basically gapped higher. It traded up about 4%, up to about $165. And over the last 4 days, gave it all back, right? Like, and so all of that positive earnings reaction was given back. And so you don't want to just assume that whatever after hours traders are baking in is a real kind of gauge as to what the stock will do in the next 3, 4, 5 trading sessions.
Yeah, right.
This is going to be really important to see how the dust settles on all of this.
Okay, so which chart should we look at next? Do you want to look at gold?
Absolutely. Now, gold, what an epic bull market. Now, what's interesting is that this is actually where there's a beautiful kind of scenario where it's a learning lesson, I think, for technical analysis versus fundamentals. Because what you know very well is that there's a huge macro geopolitical shift happening in the world today. And Trump started by stirring up a hornet's nest, but there is clearly an agenda to kind of break the momentum China has, and to kind of bring them in line, or whatever the grandmaster strategy is. But there's a clear targeting of China, and China has obviously been running massive trade surpluses, collecting huge amounts of treasury bonds and resources in this process. And the U.S. is trying to rebalance this. Whatever, I don't know whether they're going to flip the trade surplus or not. Like, I don't even think it's even possible. But they're certainly trying to kind of realign things on a global geopolitical scale. The thing is that all of these players are realizing just how vulnerable they are. All the countries, vulnerable they are by being in the U.S. dollar system, solely in the U.S. dollar system. Because I don't think that there's going to be an end of the U.S. dollar system per se. What there's going to be is a diversification away from the U.S. dollar system, where instead of 85% of all global trade being backed by the U.S. dollar, it might drop to 65%. There's going to be countries that are going to find alternative ways to settle international trade. But also, what's a realization is that you can't be enemy number one and have a shitload of U.S. Treasury bonds on your books, because we all know what happened with Russia when and all of their holdings once they pulled their move. And so China is diversifying into gold. They're basically buying every ounce of gold that they can get their hands on. And you can do all of the technical analysis and give me the RSI is at a 10-year high over bought condition, guaranteed some sort of top. But that's not going to change the geopolitical landscape or what these countries have to do on a global scale. You can't use an overbought metric like that to basically evaluate that somehow, therefore, gold is a short opportunity, or this is the major top in gold. That's nonsense. But what we have seen is a short-term trading high.
So, Mike, would you use anecdotal evidence for that? Like, as an example, I saw a story on CNBC today that was telling people, giving them a strategy to sell their jewelry for gold. And it reminds me of like the 2011 top, where almost every single commercial on cable television was "We buy gold," and then you go down to the local mall and like every kiosk is "We buy gold." So,
Yeah.
if you saw that again, how would you include that into your overall analysis?
That's the tricky part, because I don't actually believe that we have truly seen that euphoric stage. What do I mean
Well,
by?
nothing we have. I'm just saying that
No, what there would be like, but what were the characters? Go back to 2010, 2011, when gold was at its last major high, right? So let me just come back here on a weekly chart and look at the last major gold run. This is that big parabolic rise where gold basically went from $200 to $2,000 in a decade.
Yeah.
Right. It was an epic run. At the end of it was a 10 bagger, right? It was 1,000% increase in gold. I'm obviously running a little bit, but we're just making it simple to understand. At the end of that, the gold miners were going gaga. Every investor wanted it. The amount of money that was being thrown at every gold junior miner out there to go and find the next major gold find, and all of the excess money that was very poorly invested, led to one of the most devastating gold bear markets that followed, because of all of the excess euphoria that was in there.
Right.
Right now, nobody gives a shit about the gold miners. I mean, sure, they're higher, but no one's rushing off to finance the next, the gold exploration, and all the juniors aren't rushing out. You're not seeing this in euphoria yet of all of this money that's going to be made from gold. I believe what we're only seeing is a short to intermediate top on gold. It is not the top on gold.
Do you think that Bitcoin's taken a lot of the flow away from the miners?
I don't know. Yeah, a little bit, but what I do, I can't deny that point. I don't actually want to say that it's not the case. Of course, money, then when there's a certain pool of capital, and the investors in the pool that usually buy Bitcoin and gold distribute it more evenly or equally amongst opportunities, it means some of the money that would have naturally in the past have found these miners is now finding crypto. But we saw an extraordinary thing happen this year, which was gold and gold miners massively outperformed crypto. And this left a lot of the FOMO chasers, where the people that chase performance, to have to rejig their holdings, right? No one wants to hold an asset that's not moving while the alternative one is ripping. This is what made Bitcoin steal so much from gold in the last run. Now gold is stealing it from Bitcoin and the opposite end.
What does the chart of the miners look like, Patrick? Like, what does this chart of gold look like compared to like what's the ETF, the GDX?
The GDX right here. So it just broke to a 52-week high. So think about it, we only exceeded the 2020 high right now in the last few weeks.
Right. So it broke a lot of resistance there.
Yeah. And more importantly, put this on a monthly chart, and you recognize we're nowhere near the highs where we were when gold was at 1900, right? Like when gold was at 1900, the gold miners were up at 60, 62. Now gold's at north of 3000, and the gold miners are still cheaper. Point is that there hasn't been some huge kind of parabolic move that has like made these miners go into some sort of like bubble phase. There is still a lot of money to be made, but that doesn't make buying today the most tactical. I buy dips, not rips. The biggest issue we have today is that there was a lot of money made in the last 3 months, and there's a lot of people that have felt left out of this rally. And the natural instinct is, well, shit, I got to buy something, and they want to chase. But the best buying opportunities are always during profit-taking cycles, not chasing performance as the things are 52-week highs. There is a diminished asymmetry in rushing to buy gold here right now. I feel like we're likely to enter a period very reminiscent of October and November, where gold basically for 3 months just traded sideways in a triangle formation, rather than being in a bull trend, right? Like, but it was just a pause.
50-day moving average kind of catches up to it.
It catches up to it, and it just kind of sits there for a couple months, takes a breather, and then continues. After such an advance, it would not be a shocker if the remainder of the second quarter was something of the sort where we just kind of traded in a kind of a consolidation of some sort in here. Right. But that doesn't mean in the second half of the year that gold isn't heading to 4,000. It's just the kind of ebb and flow. And so at this moment, I'm bullish gold, but for new positioning, I think you buy dips, not chase up here.
Can you go back to oil? I don't know if you discussed
Yeah.
that, but I'd like to definitely focus on that because it's
Yeah.
not only just about oil, but this is telling us a lot about the underlying economy
Right.
and the fundamentals.
And so you have a scenario here where uh, we had a major support line that established itself back over here in the $66 to $70 range. And we have a scenario here where this breakdown broke a major support line, and now what were all previous supports act as overhead resistance. This is as ugly of a bearish chart as you're going to get.
I was just going to say, out of all these charts you brought up, this one is the ugliest. That was just
the ugliest.
my mouth.
It is the ugliest,
Oh,
and using a
analysis textbook. Yeah,
absolutely.
you know.
And there's a simple saying that is often used, and our listeners can always try to remember it in technical analysis. There's a saying that flags fly at half mast, which is basically that whatever the length of the first decline, in this case, that decline was $13.50, about 19% on the downside. So with the flagging formation developing, often the next leg has some sort of symmetry to the prior decline. So another $13 decline is down to $50, another 20%. So like we could see a $50 oil.
I'm out here for a second, Patrick. So gold or oil at $50, viewers, what does that tell you about what's happening with the global economy? I mean that,
and what is it will tell you about the Permian now and the drill baby drill motto of
they can make money.
They can't make money, but I want to highlight oil would have to be down there on the long-term basis in order for that to be a problem, because we could easily see a scenario where we get down to 50, trade back to 60, and then spend most of the summer washing around 60, 65. And the trip down to 50 was just knocking out stop losses and just kind of the market voting on short-term supply and demand. And that wouldn't change the fundamentals of U.S. oil. What would be a problem is if it got down to 50 and stayed there. Now we're freaking talking problems. And so
what that represents, or what that's telling you about the economy.
Well, it's telling you that because it's a global thing. Because this is, for instance, this is WTI, but let's take a quick peek at Brent oil, right? And when where do I got Brent here? Like Brent oil is just as ugly, right? Like you're talking about global oil demand getting plummeting, which basically means that this isn't just a U.S. recession. This is a global slowdown, right? And this is pretty evident because the tariff issue is a global issue. And the thing and this is the funny thing, is because almost all global central banks are actively cutting interest rates because they see and know that this recession is upon them. But yet there's one central bank that doesn't seem to get that picture, that memo, right? That's the Fed, who's like, no, well, Japan is a whole other basket case. It's but it's they seem to not kind of correlate with the rest of the world on their cycle. But the bottom line is normally, like, go to the last 5 years and observe that since COVID, every global center, not every so, like the ECB, Bank of Canada, the Bank of Australia, all of these different Western world central banks were literally interest rate hike by interest rate cut synchronized. They were all basically cutting at the same time, rising at the same time. And yet now the divergence for the first time in 5 years has happened in the last year, where Bank of Canada and Europe and everything are cutting, and the Fed says, no, we just want to see what happens here. And that's bizarre to me. But we clearly see oil prices demonstrating substantial weakness, and the trend is down. By the way, though, I want to highlight something. In the big picture, I am super bullish gold. Oil, super bullish oil. I actually think at the end of this comes an amazing opportunity to make money, but you can't be early to it. Like we might be in July looking for a market bottom. Like, just because it's cheap doesn't mean you should go and do something about it today. This is the beautiful part about technical analysis, is that it's not just identifying that something is cheap, but then you're also trying to identify when have market participants started to accumulate it. When have we seen that it has divergent momentum, creating basing formations? All dips start being bought very quickly. Like, where is the money starting to vote that this is now a cheap price where we're going to accumulate? And there was zero sign of that on oil right now, zero. And it could take months to establish that. And so right now, oil's pretty darn bearish.
Why don't we do the 10-year?
Absolutely. You want to look at yield or bonds?
Yield on the Treasury, on the 10-year Treasury.
So here we go. So here's your 10-year yield, right? And so we're at 417. Let's round it to 420. Right, we were up near almost 5% back at the start of the year.
Okay.
And
what would you be looking for specifically in this chart?
So I'm in the camp where the clarity you love talking about the yield curve.
Yeah.
And so let's start off, before we look at this chart, let's look at the 210s. Right. And what we have is a steepening happening. And who is it that was just recently on one of our episodes that said Trump is a human steepener? And
is which way? And
well, is it a bear steepener or bull steepener? But actually, but here's the thing: it actually has been so far simultaneously both, because we have had.
Like, go back to GFC, Patrick, exact thing. But if you look at rates, like 2-year, 10-year, going back 12 months, it's a clear bull
steepener, right? So we and this is why that we're long the SOFR futures, right? Right, because you're betting on Fed funds in the front end, like this that 2026 SOFR we were looking at the beginning of the episode is essentially like a 2-year bond. Like, you're literally going to have direct correlation, and therefore a bull steepening is going to be that ripping, right? So we're in a complete agreement on this.
It's on the 10-year, because aside from what the 2-year is doing, the 10-year is telling me more about growth and inflation expectations.
So right, and I at the moment am a little more neutral here, because what's clear is that the response mechanism of even the central bank providing liquidity, we would need some Operation Twist and or some quantitative easing program to be coming in, where you basically have the deliberate buying of long duration bonds to target specific interest rates on establishing a fixed yield curve or some sort of kind of thing that they would do. Right now, I feel that the central banks are targeting maintaining stability in short-term lending. And this is where I think the 10-year for the interim period can be messy. It doesn't mean that if things break, like if we go into an economic recession that basically has corporate earning contraction, that has disinflationary pressures, growth pressures, all of these things, that we could be at 3.5% or 3% on the 10-year. Like, if things get bad,
that would not require QE. That would not require.
No,
That's
no.
where we differ a little bit, because I don't know that QE really does impact. I don't think it has a bigger impact in growth and inflation, because sure, you've got the Fed in there giving it a bid, and I get the whole argument there. But at the end of the day, I think that it's kind of which is coming first, the chicken or the egg,
Right.
Is it that the Fed is buying, or is it that growth and inflation expectations are going down, and that's the reason the Fed is buying, and therefore people assume that the yields coming down is the Fed buying, when it's really the first part of the equation. And what I always go back to, is QE 1, 2, and 3. And QE 1, 2, and 3, the 10-year ended higher than it started. And that's because even though the Fed was in there buy, people in the market saw that as growth and inflation expectations increasing.
Right.
So anyway.
So if I was to just give you a technical forecast of like just using the same rule. So let's use the same rule that we used earlier about, let's say that this consolidation is the midpoint. And what you observe is that the first drop in yields was about 80 basis points.
Okay.
Right. And therefore, if the second drop was symmetrical in size and was at 80 basis points, it would send you right back to the September low at 3.6. So basically, if this break it stays below the 50-day and trends, you're going to be talking about us going back to September lows on the 10-year. That doesn't mean it can't go lower after that. It just like that would be the tactical trade for the next 3 months. If you're calling for recession risks, we could see that kind of move.
Patrick, how are you using the VIX as another data input to determine the probabilities of the bear market and equities continuing?
I only use the VIX for one thing: extreme. Like when the VIX, for instance, blew out back over here up to 50. That was a clear indication to me that a short-term trading low was establishing itself in the market, because you don't. But I don't try to use it for predictive power beyond extreme points in the market that offer opportunities. So, like when I saw the VIX up in the 50+ range, we covered all of our short positioning and we started fucking buying everything that wasn't nailed down. Like we basically were. Went on a bit of a shopping spree, but the VIX to me is what is the most important thing to observe about bear markets. And again, on a weekly chart, I want to highlight, for instance, in 2022, right during the last bear market, notice the VIX never really traded below 20 on a sustained basis for a year. Remains elevated, right? And even in the post-COVID period, for almost a year between 2020, the volatility stayed elevated above 20, right? Think of the bear market, let's say the great financial crisis. We didn't see levels below 20 on the VIX until later towards late 2009, 2010. Right, like once the VIX broke out, and it wasn't until the bear market was over that you got lower VIX. So using that as a template, if my speculation on this being a bear market proves to be correct, then what I would say is we should not see the VIX drop below 20, and we should see it stay basically in this north of 20 period. And if it does, it means that insurance premium on protecting portfolios is commanding a higher volatility premium because the conditions warrant a bear market of some sort, and they're not going to sell insurance for free. They're going to make sure you pay up for it. And so if we stay in a higher elevated volatility levels, that to me is a further confirmation that this is a bear market that has further downside risks.
Okay. Buddy, how can people find out more about what you do?
BigPictureTrading.com is where I have my subscription. But like you, I'm messing around on YouTube on my Patrick Ceresna channel. It's having fun chatting on there. So anyone who wants to follow my YouTube stuff can just find me on there.
Awesome, buddy. Thanks for your time. I always love getting into these charts and looking at the technicals, and I think this is a very important component of the overall analysis. I think it starts with your macro fundamental view, and then you kind of figure out, okay, what's the best way to express the bet? And then you look at the charts to kind of time when you should put that in and kind of your risk management.
The way I say it is the macro and fundamental tell you what's going to happen and why it's going to happen, and the technicals tell you when it's going to happen and where's it going to go. And the thing is that be a really good trader, you want the perfect combination of both, and you shouldn't just have one or the other. A really good trader knows how to put them all together.
Yeah. All right, buddy. Thank you for your time, and
love being on the show, bud. I'm going to come out to Medellin and come party with you again. It was awesome.
All right. You're always welcome, buddy. Have a good one.
All right. Have a good one. Cheers.